Hey, what's up guys? Welcome back to the channel. Hope you all are doing good. So after watching the last two videos, I'm sure now you guys must be comfortable with the income statement as well as the balance sheet. So now you basically understand the structure, the flow and the line items within the income statement as well as the balance sheet. So in today's video, we're going to dive deeper into the income statement. We'll look at what are the factors, what are the metrics that you must look at when investing in a company, and how we can use the income statement to differentiate between potentially good companies and potentially bad companies, because 80 to 90% of our decisions are going to be based upon income statement, and the rest 10% we'll look at balance sheet as well as cash flows. Because you pay attention to this, an improving income statement means what? Sales are increasing, means what? Demand is there, people are going to buy the product, profits are also increasing, means what? Companies earning profits. And then a good income statement has the power to turn a bad balance sheet into a good one. Now let's think about it. What makes a bad balance sheet? Okay. First of all, high debt to equity. Debt to equity means debt divided by equity. Now equity we also saw promoters capital, R capital and the retained earnings, right? So if company's profit goes on increasing, the retained earnings will go on increasing. As the denominator increases, the debt to equity ratio will come down and debt will become at a manageable level, right? So as the profit goes on increasing, the income statement goes on improving, and what happens? The balance sheet also goes on improving. ठीक है, लॉजिक से समझो. As the income statement goes on improving, a bad balance sheet can turn into a good one. As we'll see in turnaround companies, we'll exactly see how we can identify this. But a good and improving income statement can turn a bad balance sheet into a good one, whereas a good balance sheet with a bad income statement has the power to turn a good balance sheet into a bad one. If there's no growth in the company, you can't make money. ठीक है, look at for example Asian Paints, Hindustan Unilever, Britannia, Colgate, all of these have very good balance sheets. But what? Income statement is not improving, there's no growth in the business, and as a result, as an investor, you haven't made money in the past couple of years. Whereas if you look at some of the turnaround companies, you'll see an improving income statement has transformed a bad balance sheet into a good one. What happens is, people usually wait for the bad balance sheet to turn into a good one, and till then the stock has already moved up 5-10 times. Okay? And valuations have become expensive. Now you'll see, oh, company बहुत बढ़ गया, I can't buy it right now. Okay, so that is why we will give most of importance to the income statement. So along the video, we'll also look at some of the mindset or some of the blockages that early investors have, and something that I personally had as well. So on that note, let's start the video. So first, I'll talk a couple of minutes about mindset. Okay, mindset. Needless to say, in the stock market, in terms of investing, you need to have a longer term in nature. Okay. Now don't confuse this, because I've seen a lot of people, they stay in a bad business for a longer term. That is exactly opposite of investing. In investing, we want to stay away from the bad businesses and want to stay in the good ones. Now it's not possible to find exactly 100% good companies. There will of course be 5-10 bad companies in your portfolio, but you must be able to cut your losses early and exit from them, because we only want to stay invested in those companies which companies are showing growth, which companies have the potential to grow. We don't want to stay in companies that are dead. We don't want to stay in companies in which income profits are not increasing, sales are not increasing, only a good balance sheet. We don't want that. What we want as investors is growth, because one thing I've learned is that money always chases growth. The higher the price at which you grow, higher will be your valuations. Valuations we'll discuss separately, but the pace at which you grow, that matters more than your balance sheet. For that, you need to read con calls, that is conference calls. That is basically where you can interact with the management. You can ask them questions like, why is your margin declining? How can you see your sales growth improving? All the questions that you have related to the business. Then there's investor presentations. So con calls and investor presentations are going to be two main source of information for understanding and evaluating a business. And as I mentioned as well, we have to filter good businesses from bad ones. We have to consistently keep on rewarding the good businesses that are performing well and can perform well going forward. And we must exit or punish the bad companies that are not performing as well. And we always consistently have to track companies. Okay? We don't have to judge a business whether it's good or bad in a second. Because what I did in my early investing career as well is I would go to the balance sheet, I would look at debt, and I'll be like, high debt, bad company. And later on, I saw that these companies grew 5-10x. Okay? So we don't have to judge a business very quickly. We must always track them, because stock market is such a place where a good business today can do bad going forward, and a bad business today can do well going forward. So we always have to track these companies, so that whenever the company shows signs of improving, you can enter in it. Because the earlier you enter, the longer you have the time frame to hold the stock, and also you can plan your exits quickly as well. And this tracking business, this is a perpetual task. If you want to be active investor, if you want to make money, you have to be active. You can't just be like, I'll read this later. Because if you have invested your money in some company, let's say company comes out with results seem good, but in the con call management says we won't be able to grow at the same pace. what happened? Your money is gone. Stock circuit में open हो जाएगा and you will lose all your money, right? So you almost must be very active. You must perpetually track these companies, track different types of companies. I'm not saying track 100 companies. Even when I started out, I started only 5 companies. Track 5 companies in a sector. Then after you get a hold of that sector, it will be easier to track these companies, right? Because you know how this industry works. You'll know what metrics you look at, order book you look at, order inflows, management guidance, margins, bus. Then once you track one industry, you'll move to next industry, and so on. And basically, you'll track multiple businesses, so you know when one business is doing good and one business is going to do bad. Why? Because market is always forward looking. Market does not care about past. Market does not care how well you've done in the past or how good your management is. Market only cares about future. If management is saying we'll grow in the future, irrespective of anything that's happened in the past, market will reward it. If you have a very good management, like pristine management, but you're saying going forward we will not grow at good rate, market will not reward you. As simple as that. Look at Wipro, Asian Paints for example. Okay, very good management, but what's happening? No growth. Market is not rewarding them. Stocks have not made any money in the past couple of years. That was a thoda mindset ka rambling. But now let's look at the income statement में deep dive. So within the income statement, the most important factor is the sales growth. ठीक है, margins and net profit come secondary, but the most important is sales growth. Even though as shareholders, EPS should be of most concern to us, but in my opinion, sales growth is the most important. Now I'll tell you why. Assume 2 companies. One company is growing at 30-40%, whereas the other company is not showing any sales growth. Okay, I'm talking only about sales growth, not the margin front. Okay, first company mein what's happening? There's good sales growth, there's good demand for the product, people are willing to buy that product, right? What will happen? As company sells more and more, company will grab more market share. Okay, imagine this, okay? Just understand the logic. This company will grab more and more market share. Okay, take for example Zomato and Swiggy. Okay, Zomato is consistently growing sales at a higher pace than Swiggy. What will happen is Zomato will take the market share from Swiggy. There will be more and more demand for Zomato. Okay, now then there will be economies of scale, then margins will improve, but that's a different topic. Only sales growth pe dhyan do. If high sales growth means what? There's high demand, there's higher satisfaction. Whereas on the other hand, if there's no sales growth, means what? There is no demand, there is no customer satisfaction, the market share will be reducing, or the market share will keep on reducing. If there's no demand, Swiggy will not do any capex, there will be no growth. Then after all, what happens? No profitability for you, and as a shareholder, there's no value for you. Okay? But on the other hand, if Zomato, even though Zomato might not be growing profits at a faster pace as compared to its sales growth, what's happening? Going forward, if the sales growth is there, then company can start. If sales growth is there, then maybe company can use some cost optimizations, and then margins will improve. But if in case of Swiggy, if there is no sales growth at the current point, okay, what the company will do? Company will cost optimize. But company can cost optimize up to a certain level, na? Company can fire some employees, company can bring cost optimizations, but that is only applicable to a certain extent. After a certain point, you need to bring sales growth, right? So that is why sales growth is the single most important factor within the income statement. That will show you how the business is doing at its core. And sales growth में we want sales का growth. ठीक है? Remember in the first video talk about year on year, quarter on quarter growth. What we want is growth, not the absolute number. ठीक है? Because you look at a TCS के sales, that's a very big number, 6-digit crore number. ठीक है? Whereas if you look at small companies, they'll do like 2-digit, 3-digit crore numbers. Okay? So what matters is not the absolute value of sales, but the sales का growth. Year on year growth or quarter on quarter growth, that is more important to us as investors. So I'm sure the sales growth ka point is clear to you ki why we need sales growth. More demand, more customer satisfaction means people are willing to buy that product. If people are willing to buy the product going forward, if company can raise prices, margins will improve. Then what? Market share will improve. All of these factors. Okay? Look at for example Zomato and Swiggy. Zomato is gaining market share. Zomato is profitable. Zomato is increasing its outlets. And all of that. So Zomato mein that's going right. Zomato mein also you see sales ka growth is more important rather than the actual number. Whereas if you look at Zomato, you'll see ki company is growing at 70-75% se company is consistently growing. Whereas if you look at Swiggy, what's happening in Swiggy? Swiggy first of all is loss making, and what's happening is company is growing sales by only 45-50%. Got it? 45-50% and 7-75%. That is a very big gap, and that is why Zomato ka stock has created money, whereas Swiggy ka has not. So sales growth mein there's 2 components. Okay, first is the sales growth. Imagine this: there's sales growth, then there's volume growth, then there's value growth. Okay, sales growth, volume growth, value growth. Understand? Volume means basically increase in the number of quantity of the product you have sold. Now let's take for example chips. Okay, last year you sold 100 packets of chips, but this year you sold 200 packets of chips. Means what? There is increase in quantity of packets that you have sold. Okay, there is increase in volume. So 100 packets ka chips you sold, now you're selling 200 chips of packets. Means 100% volume growth. Okay, year on year basis pe. Understood? This is called as volume growth. Now the second kind of growth is value growth. Okay, value means the monetary gain. So for example, if your chips was for 10 rupees, now you're selling that chips for 12 rupees. You sold 100 packets for 10 rupees, you made how much? 1000. Whereas you sold 100 packets for 12 rupees, you made 1200. Okay, so your actual sales growth was how much? 20%. This was your value growth, which means how much value you increased, that is 20% ka value you increased. Now these two factors, that is your volume growth as well as the value growth, these two, if these two increase, then your sales growth on a consolidated level will increase. First year में you sold 100 chips for 10 rupees, you made 1000 sales growth. ठीक है, assume this. Then second year में you sold 200 chips के packets for 12 rupees, you made how much? 2400 as the sales. Okay, first year में sales was 1000, second year में sales is 2400. First year में sales volume was 100, second year में volume was 200, growth of 100%. Then first year में value was 10 rupees, second year में value is 12 rupees, that is a growth of 20%. Okay, so if your volume and value growth, they add to increase your sales growth. Ideally in a company we want sales growth as well as some sort of we want volume growth as well as some sort of value growth. So ideally what we learned, sales growth mein there's two types of growth. First is volume growth, which means increase in number of packets or increase in number of quantity of the good that you've sold, and second means value growth, means increase in the price of the chips or increase in price of the goods. Okay, these two factors they assume to your sales growth. बस sales growth में इतना समझ लिया, बस हो गया. You've understood the first part of this. So if you guys are liking this video so far, make sure to like and also drop a comment down below as to what is your favorite part of this video. Now we'll understand the three scenarios of sales growth with examples. So first example may be discussed only volume growth. Okay, so volume growth may means what? These companies का sales growth will come only due to volume growth when they sell more and more quantity of the product. ठीक है? So now why these companies में only volume growth है? Now let's take for example Vishal Mega Mart. Vishal Mega Mart, what it does is that it sells wide range of products like apparel, grocery, electronic, home essentials. You can read this on screen now. But what it does is that it is a tier 2 or tier 3 competitor to DMart. What I mean by that is that DMart, this is a competitor to DMart targeting the lower middle class and lower class families. It provides cheaper alternatives. Okay. Now because it provides cheaper alternatives, the business does not have any pricing power. Because if Vishal Mega Mart increases prices, people will go to DMart. They'll be like, DMart mein I'll get better quality. I'll basically go to DMart if Vishal Mega Mart is increasing prices. Only reason I am with Vishal Mega Mart is because I'm getting products at cheaper prices. Okay, so Vishal Mega Mart mein all the growth that will come only due to volume growth when they sell more quantity of goods. Okay, and if they do cost optimization here and there, then margins can improve. A little bit, but not so significantly. So volume growth company mein hai. So what this company means, this company needs a good distribution network and an expanding distribution network, because if company has a good distribution network doesn't mean कि आगे जाके भी it will improve. ठीक है, company always needs to expand the distribution network to bring about more volume growth. With that, we look at the second business, that is there's only value growth in this business. ठीक है. So now let's take for example any hospital business. Okay, hospitals maybe there's two things. First is your volume growth, which means occupancy. So occupancy means what? You suppose you have 100 beds in your hospital, your occupancy is at 80%. It means 80 beds are occupied. That is your occupancy. Okay, now think about it. If 80 beds are utilized, now if you can utilize 90 beds, that becomes your volume growth. Okay, if 80 beds are occupied, and you can somehow increase it to 90 beds are being utilized, then that becomes what? Volume growth. Exactly. And on the other hand, if you increase the revenue per bed, that means you increase the price of each bed or the price of each service, then that is your value growth. Understood? Your occupancy means your number of beds that are being occupied, that's a volume growth, and the average revenue per bed means the revenue per bed, or that is your value growth. Okay, so now let's take for example any hospital. Now let's take for example Fortis Healthcare, right? Guidance was also amazing for Fortis Healthcare. And so if you look Fortis में क्या हो रहा है, you look at the kind of sales growth company has been showing, and also look at the margins. Margin have also been expanding, but that is due to operating leverage, which we'll cover into another video. Okay, so in these companies, how will the growth come? First is once they increase the occupancy. Earlier 50 beds were being occupied, but now 80 beds are being occupied. That is your volume growth and value growth. Because hospitals, that is kind of like a inelastic demand hai. So even if prices increase, demand will remain the same. If your average revenue per operating bed, that is RPOB in hospitals, if that goes on increasing, that is a sign of value growth. So now also we look at another example of volume growth as well as value growth. Okay. Now a classic example of this is Ethos. Let's take Ethos, that is basically makes your luxury watches, your Swiss watches ranging the price of 2 to 2.5 lakhs. Okay. So this company may also see कि this company में volume growth will come when they sell more and more number of watches. Value growth will come when they sell higher range of prices, means luxury watches, means higher end of prices. ठीक है. For example, let's say I was selling 100 watches at a price of 1 lakh. ठीक है. Now what I'm selling is I'm selling 150 watches but at the price of 2 lakhs. ठीक है. What company is selling? Company is selling more of these expensive brand watches, ranging from 2 to 2.5 lakhs. ठीक है. And 2 to 2.5 lakhs, let's say for example, if you're able to buy 2 lakhs ka watch, will you think oh, price is increased by 10-20,000, I won't buy it? No, you'll be like, okay, 10-20,000 doesn't matter. If I like the watch, then the watch is good. So Ethos ke example mein, why there is volume growth when you sell more number of watches? Why there is value growth? Because you're increasing the prices of watch. Okay? Why? Because there is first of all pricing power. You're catering to the more premium crowd. Okay? That is why premium crowd will be able to pay premium. That is a pricing business, and that is why your value growth will come. Your PNGS Gargi. Now I won't go into deep, but what is happening? They have two divisions. First is the gold division, and second is the diamond division. Okay? What interesting thing is happening within this company is कि their gold jewelry division, that is driving your volume, means they are selling more and more products. But the diamond division, that caters to the more the more premium side, similar to how we saw in Ethos example, that is catering to the more expensive side, to the more premium side. That's why consumers are willing to pay a premium for that. Okay? So gold division say there's coming volume growth, and then diamond division, premium division say there's value growth. So both of these combine to give you good sales growth. Okay, I hope you guys must have understood this. I've explained this in detail. If you need more further clarification, comment down below and I'll basically try to answer your queries. So basically, just to summarize what we saw, first in the mindset, we have to be longer term in nature. We must track businesses, not judge businesses. Okay? Income statement has the power to turn bad balance sheet into a good one, and so on and so forth. Sales growth, why most important? Shows demand, shows if customers are satisfied, shows market share gains, basically shows how the core business is doing. Okay? Within the sales growth, what we saw? Volume growth, increase in number of quantity of products sold, and then there's value growth, which means increase in price of quantity sold. Okay, now we saw the three scenarios as well. There's only volume growth, only value growth, and there's a mix of both. So I'm sure in this video you guys have completely understood sales growth are different factors, and how we look at sales growth. Okay, in the next video what we'll do is we'll understand a basic analogy. Okay, F1 key analogy say we'll understand how we can differentiate a bad business from a good business, and a business that is going to make us money and business that is not going to make us money. So stay tuned for that. So that was it for today's video from my end, guys. I hope you found this informative, you understood the sales growth topic, and if you found it informative, make sure to like, also drop a comment, and also subscribe to the channel to stay part of this journey, and also share with your friends who are interested in investing and learning more about this stuff. And I'll see you guys in the next one. Thank you.